Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Neil Insull and Suzanne Briggs.
Welcome to The Tax Factor. Hello, I'm Neil Insull, stepping in for Michael Holland this week. Well, we did promise you, Michael. Unfortunately, he's gone down with some nightmare lurgy. He's lost his voice, but I hope not his sense of humour. So from me and from everyone at Blick Rothenberg, get well soon, Michael, and the mic misses you. But don't worry. All is not lost. We have got in a very special person. My colleague, Suzanne Briggs, is joining us, making her very first Tax Factor. So this is her debut. And hopefully you're not too traumatized by the last minute host swap. So you prefer probably Michael or Nimesh or someone like that to do this job. But I'm here. I'll keep things relatively smooth, or at least mildly entertaining. So welcome, Suzanne.
Gosh, thanks, Neil. What an intro. And I am honoured to be here. Thank you. And yeah, also... Damn
sight better than having Roger here, I must say. I mean, Roger's not quite gone yet, but he's... But anyway, no, we love Roger.
I have to say, I was quite worried about filling the big shoes of Roger. You and Roger make a really good team on the podcast.
What about filling the big beard? Where's the big beard?
I would hope I would never, ever fulfill that.
Anyway, look, we've got a really, really good podcast in line here. So some entertaining subjects
yes.
As we entered into the summer months. Just to give you a précis of what I hope we can cover, Suzanne. And I'm looking for you here to add the expertise. These are topics which fall very neatly into your sweet spot. So we're going to be talking about Reform's Britannia Card, some interesting developments from Reform's tax policy. We'll also be looking at the success of the Revenue in investigating some rich people, and we'll be talking a little bit about what's called the tax gap, the difference between what the HMRC expect to raise in taxes and what they actually do, and we'll go into a particular part of that tax gap and explain why that's important and interesting. And I mentioned before, we're on the cusp of some exciting summer events, including Glastonbury. And Suzanne, you've got an interesting story we want to pick up that was in the press earlier this week on Glastonbury and founder there. And also we'll have a brief mention about Wimbledon, a tax angle on that. A lot to get through. We've only got a few minutes. Well, you'll listen to a few minutes at home, but we've got basically all afternoon to talk about it. But clever editing will bring it down to a digestible length. But anyway, let's kick in. Let's talk about this. I'm laughing already, but I'm not going to laugh. It's a very serious aspect. Is Reform parties. So it's worth mentioning that I think the latest poll suggests that Reform probably have something like 34% of the vote potentially at the next election. So Reform is to be taken seriously, and particularly around some of their tax policies, of course. Not only what they said in the manifesto or the social contract, or what they called it before, but something that's come out recently, which is a proposal for a Britannia Card. And this is all in the context of the changes in the non-dom rules, which were initially brought in by the Conservative Party and now being also reinforced by the Labour Party. So we're going to see some big changes on the non-dom front. There's been a lot of criticism, obviously, about some of those changes. Reform have reacted to that and said the non-dom changes rules is not a great idea. We've got something which is not replacement of the non-dom rules, but something even better. So they're talking about introducing a Britannia Card, and this is not to be confused with the Britannia Hotels loyalty card, which I believe is also available from Britannia Hotels. Anyway, what it is basically it's an opportunity for what they describe as internationally mobile wealth creators to pay a so-called landing fee of £250,000. And I believe, I'm still not sure whether that's intended to be every 10 years or indefinitely, a single one-off 250,000 in exchange for this Britannia card, which I don't think is a real card, or maybe it might be, essentially to be taxed on a remittance basis only, and for all international gains and income to escape UK tax. So to be exempt from UK tax on those foreign income and gains, and only to the extent you have UK earnings or remitted earnings that you get taxed on that. No inheritance tax in the UK either. And something I saw this in their proposals, a Britannia residence permit, and this does talk about a 10-year renewable multi-entry residence permit, which I can't work out whether that is part of the Britannia card tax exemption or not. But anyway, so what this is essentially to incentivize people to come to the UK for a single fee, have a very tax advantage tax regime for themselves. This, though, would not add to the coffers of the revenue. The 250,000 that would be paid would be redistributed to our working people in the lowest earning population. They're talking about a redistribution to the lowest earning 10% of full-time workers. And they would redistribute this money by way of essentially a dividend, a non-taxable dividend. And they've put some numbers together and said, look, if we issue 6,000 cards, Britannia cards in a year, and raise 1.5 billion, that means that these low paid workers would each get a tax-free dividend of £600 to pay for, I don't know, holidays with Britannia Hotels or whoever. It all sounds a jolly nice idea, not tax raising, but essentially to increase the attractiveness of the UK to wealth creators from overseas, which will bring in plenty more money and growth to the UK. What do you think, Suzanne?
Well, it's certainly an interesting policy that's been announced by Farage. What I want to know is, I have read that there will be an actual card. I want to know what this card's going to look like. Is it going to be an actual gold card with a union,
gold, platinum,
with a union jack?
Maybe it is made of gold.
Yeah, exactly. How much is that going to cost to make as well? I mean, the OBR have said that the policy is going to cost £34 billion. Apparently, we have a card as well. It's going to cost even more money. Although, in all seriousness, I think it's very optimistic. He's announced a policy on the basis of encouraging job creators and entrepreneurs to come to the UK, but in reality is unlikely to attract professionals and highly skilled people to the UK because of this upfront cost. I mean, 250 grand upfront is a lot, so I don't know if it's going to really be that attractive for a lot of people. In addition, now we have the worldwide basis of taxation for the previously called non-doms, because non-doms no longer exist. We have not long-term resident and long-time resident people, not quite as catchy, but if they are here and have the opportunity to take up this new regime, they'll stop paying tax on their worldwide income and gains. So I don't know, it's much more generous than the previous remittance basis regime, but I don't know if it's going to achieve what it sets out to achieve.
That 34 billion you mentioned is, of course, the amounts that the OBR thinks that will be collected over the next few years from the reform of the non-dom rules, essentially. So they expect further revenues from the fact that people will be paying more tax in the future in relation to the non-doms that haven't left. so the ones that remain will add to the coffers, and of course those people will no longer be adding to the coffers. They'll be paying no tax at all. So that's where I think this 34 billion is coming from. I think you can understand why this policy might sound attractive to the electorate. It's that sort of Robin Hood policy of taking from the wealthy and giving to the poor. But I don't know. We'll see how that lands. We've got a long way to go.
Yeah, I think it's optimistic. I mean, the number of people who actually paid the remittance basis charge under the previous remittance basis regime was about 5,000. So if Farage is already saying we'll get 6,000 people to pay for this Britannia card, I mean, where is he getting that number? Where is he getting? Really optimistic. In terms of reversing the exodus of non-doms, I mean, we're already set to lose 16,500 millionaires this year alone due to tax and economic policies, as well as changes to immigration laws. So I don't feel
16.5 million millionaires.
16,500.
16,500
millionaires.
I was going to say, how many millionaires in the UK?
I'm not one of them. Sorry, I got that wrong.
Anyway, let's move away from the Britannia card. I think we'll see what happens with that. But we cannot dismiss the Reform Party. And I think if you look at what people are saying, that, there's a good chance that he will be our next Prime Minister. Of which party, we don't know. But anyway, let's talk about a similar point, which is going after the rich. What's going on with the revenue? What have we discovered this week, Suzanne?
So, there's been an article in the press that following a Freedom of Information request, which has revealed that HMRC's wealthy team yielded 1.5 billion in 2024, double the amount in previous years. So the wealthy team at HMRC look after the tax affairs of those earning more than 200 grand or with assets of more than 1.5 million. And HMRC believe that actually the wealthiest are avoiding at least 2.1 billion per year. So they are keen to track some of that down. And they've also had some successful high-profile prosecutions. So we've had the Bernie Ecclestone case. That was a few years ago now.
That was a huge settlement, wasn't it? It was like 400 million or something, wasn't it?
Yeah, so he had 400 million in an offshore trust. He paid something like 600 million to HMRC in tax, interest, penalties. HMRC are really going to focus on tackling offshore non-tax compliance by wealthy people, and the government are investing in extra staff in this unit by 400 people over the next 5 years.
This all means presumably maybe a bit more work for us in terms of helping our clients.
Well, yes. We are already seeing HMRC making use of information that is available to them. So they have access to information shared internationally under the Common Reporting Standards. There's also their system called Connect, which HMRC use to cross-reference data from multiple sources. They need to make better use of the data that's available to them. So I'm expecting that HMRC will raise more inquiries, and that's going to be, yes, additional work for us because we will need to help our clients deal with the questions raised by HMRC. So inquiries can be pretty far-reaching and they can be quite intrusive. So taxpayers can be asked to provide bank statements, trust documents, details of offshore income and asset. Did you know, Neil, that the average inquiry lasts for 3 years? That's the average inquiry. So if you get one, it's going to be taking up a lot of your time.
It sounds like you got a job for life there, Suzanne. So.
I don't. Yeah.
So it's an interesting, which actually, I mean, it's an interesting area, and it demonstrates that they are tackling what the so-called tax gap at the high end and the high net worth end of the spectrum, which sort of brings me neatly into another story which has emerged in the last week or so, which is the extent of the tax gap generally. Okay, so the tax gap is essentially about, and we're going to have to rely on the government's figures for this, but it's estimated that the tax gap, and that's the amount, as I said before, between what's expected to be raised and what is actually raised, is basically 5.3% of the theoretical tax liabilities, 5.3%, which is a damn sight lower than it was a few years ago. And there's been quite a lot of success in the revenue closing the tax gap. And I think there's been a lot of good work. I mean, we could be very critical about the revenue in all sorts of ways, but I think there has been a lot of effort to focus in on what that tax gap is and trying to reduce it. And there's been various ways of doing that in terms of education of taxpayers, putting more resource into the risk areas and so on. And as you just said, Suzanne, one of the key figures that's come out of the recently published numbers is where the tax gap is the biggest. And that tax gap is the biggest for small businesses by far. It's enormous, in fact. Basically, they've worked out that 40% of the tax that they expect to raise from small businesses is not raised. And there's a massive leakage. And this has risen significantly since the pandemic. Something has gone very wrong in that particular sector. And when we talk about small businesses, we're talking about businesses that are less than 10 million revenue and employ less than 20 people. So not extremely small, but smallish SMEs, if you want to put a well-known abbreviation to that. And I guess the question is, what the hell has gone on? Why are companies, small sole traders and partnerships not paying the right amount of tax? And I think the answer, and Dan Needle and his guys, Tax Policy Associates, has done quite a good analysis of this. And I think generally experts would say that there's two areas where this tax gap is well, why this tax gap has evolved. And one is basically there's just haven't got enough people in the revenue who are trained enough and have the expertise enough to actually deal with businesses on just general compliance matters. So companies are left in the dark about what the right amount of tax they should be paying is. They just don't get the help from the revenue. And people are just not in the revenue there to be more proactive in assessing where the risks lie. They might do that for the high net worth, but it's certainly not happening for the smaller companies. So that is an area where the revenue really need to refocus their efforts and their resources in actually making sure that smaller taxpayers are well served, which I think everyone believes, in my experience, they're not being well served at the moment. And I think the second area is that there are clearly a lot of companies looking to evade tax and do things illegally in terms of not paying the right amount of tax. So criminal attempts to pay less than they should or none at all. And why is that happening? I think that's because, and again, Dan in his work has acknowledged this, is that there's a lot of people, a lot of advisors going around marketing tax avoidance schemes. So people thought that was a thing of the past, but no, that's still going on big time, particularly around remuneration and avoidance of tax on pay, and creating artificial small companies which are just not paying the right amount of tax. I mean, we could spend a long time talking about those particular types of tax planning arrangements which are offensive and should not work and do not work, but the revenue is still struggling to tackle that and actually plug the gap and raise the revenues they should. I think Dan in his report talks about the fact that if the revenue had the same level of success in closing the tax gap as they've had for medium-sized businesses, they would have raised something like 15 billion a year from closing the tax gap for small companies, which they've just failed to do. So this is, I hope someone in the revenue is listening, because we need to reinforce this point that this is an area which needs to be looked at in a lot of detail. I mean, Blick Rothenberg do not like our clients being poorly informed or not paying the right amount of tax, and we want to do everything possible to make sure that they do. But we don't want them to spend money unnecessarily with advisors if they can get that advice from the UK government or from HMRC. Anyway, get off my high horse on that. Suzanne, did you want to say anything before I just completely talk all the way through this podcast?
I guess the only other point I would make is the introduction of making tax digital. And I know that...
Or making tax difficult.
Making tax difficult. But I know that one of the reasons HMRC are really pushing ahead with this is they anticipate that quarterly filing for self-employed people and landlords will reduce the amount of errors that are made and help close the tax gap. Whether that will be true will remain to be seen.
Well, it does remain to be seen. Talking about tax gaps, or maybe not, let's talk about... I was trying to find another segue. In my imperfect way, I found none. But let's move on to the summer event of Glastonbury, and why, from a tax point of view, that's got in the news again, Suzanne.
Yeah, it's very topical, isn't it? Are you going, Neil?
I'll be there in spirit.
I expect to see you next week with one of those bracelets on to show that you've been there.
I'll be smoking something on my sofa watching it. Yeah.
So it's a Glastonbury, very timely in the news this week. So but basically talking about some gifts that was made by Sir Michael Eavis, who's the founder of the Glastonbury Festival. So gifting some of his company shares to his daughter and a family trust, reportedly, and I'm doing in inverted commas, I know you can't see it, avoiding RHT of 80 million.
80 million? He's avoiding tax of 80 million?
I know. There is absolutely nothing illegal in this at all. What he has done, I think it's very sensible tax planning, but that is my opinion. So it's all around the removal of business property and agricultural property relief from 6th of April 2026. And So this was announced on budget day, 30th of October last year, and there were anti-forestalling rules put in place to stop people accelerating gifts prior to the rules becoming law from April 2026. But gifts of...
Yeah, so anyone making gifts from the end of October to the 6th of April 26 were going to be caught essentially potentially by the new rules.
Potentially. But gifts of qualifying property prior to the autumn budget still qualify for relief in full. So for qualifying business property, that's 100% relief from inheritance tax. Gifts made after 30th of October. It depends on whether the individual survives 7 years or not, basically. But the article that I was reading says that the gifts were made in October. So I had a quick look at Companies House, and it shows that the gifts, my own Dan needlework, the gifts were made in the week or so prior to the budget. So tongue in cheek, but Michael Eavis is a prominent Labour supporter. So I wondered how insightful his making these gifts were.
I think we're not presuming that he knew in advance, are we? Are we? No, how dare
I?
you?
Would
How
I?
dare
No. Quite seriously, though, a lot of people were looking at accelerating gifts. There was a lot of speculation about changes to inheritance tax reliefs. So he was not alone in doing this. And people were taking the opportunity to make gifts. And probably very sensibly so, because the budget announced that from April 2026, business property relief and agricultural property relief will be reduced from 100% to 50%, which results in an inheritance tax charge of 20% effectively on death, rather than the full 40% inheritance tax. Trusts are usually subject to an immediate charge to inheritance tax unless the gift is of qualifying property. So that would mean that every 10 years there is a inheritance tax charge at the rate of no more than 6%. So for a gift made to a trust before 30th of October, assuming the shares qualify for business property relief, there would have been a full relief from inheritance tax for the shares going in and no inheritance tax until the first 10-year anniversary. So if Sir Michael set up a trust on the 20th of October, there would be no inheritance tax until the 20th of October 2034. So even then, it would only be subject to inheritance tax within the trust at the half of the full rate, so 3%. So I do think in the right circumstances, use of trust is very sensible tax planning for bearing in mind succession.
So Suzanne, if he'd left everything until after the 6th of April 26 to gifted after that date, he would have been subject to the new rules of BPR.
Yeah.
And he would have paid essentially an effective rate of 20% on the full, 400 million. I mean, that's essentially where this number's coming from, isn't it?
Yeah, if he died, within 7 years, exactly. But that's the question: is where did the figure of £80 million come from?
So the issue about valuations becomes really important after the 6th of April 26. So there's going to be a lot of revenue inquiries about valuations, aren't there? Which doesn't bode well.
No, it doesn't. And it's an additional source of income for HMRC, I would say, because they will be looking at these valuations that have been used. I mean, in this article that I read, the valuation figure was given as a range from 150 million to 400 million for Sir Michael's business. So, I mean, pick a figure. Wildly speculative, I think.
And then how does that? And then you think about how will they pay for that? And this is the problem with inheritance tax is, to the extent that there's only a certain amount of revenues coming out of the Glastonbury festival, where would all seem to be consumed by tax. Anyway, it's an interesting area of new legislation that may well change. We don't know, and watch this space.
No, you're absolutely right. We're still even waiting for draft legislation, so we shall see.
So that leads us to what I think is our closing story this week, which is, again, another summer festival, which is the Festival of Tennis at Wimbledon, and why the revenue may be rubbing their hands with joy at the prospect of international stars coming to the UK.
Yeah, so there's a couple of points here. So on an international level, most of the players will be non-UK resident. Apparently,
is that because we're no good?
But I think that's basically it. There's only 14 British players this year, apparently. Okay. And I imagine some of them are even non-resident. But non-resident players and non-resident sports people in general, they do contribute to the UK tax coffers.
Good.
Because they are not protected from UK tax on their earnings once in the UK. So that's winnings.
Good.
UK specific appearance money, or even income from marketing and image rights on a pro rata basis. I know our esteemed colleague Robert Salter did an article on LinkedIn, and his example was of a tennis player who could actually have ended up paying more UK tax on his UK source income than he actually won at Wimbledon.
And that was because of the image rights, wasn't it? Basically.
Exactly. So
enormous image rights, poor showing at Wimbledon, poor earnings, but actually because of the image rights, a proportion of that is allocated to his time in the UK, and hey presto, the revenue win.
The Tax Factor from Blick Rothenberg.
Anyway, and that's just about all we've got time for on this week's episode of The Tax Factor. Suzanne, how was it for you?
It was amazing, and thank you for being such an accommodating co-host.
Well, thank you for your valuable input this week, Suzanne, and look forward to hearing you on future podcasts. Now, next week is the final episode of this series. I know we can hardly believe it either, but we're going out with the proverbial bang. It's our end of term special feature with Blick Rothenberg CEO Nimesh Shah and the ever insightful, the Queen of Tax, Heather Self. Dream team, indeed. They'll be looking back at what 2025 has brought us in tax. So only 6 months of 2025. I mean, I don't think they're predicting the future here. A few policy U-turns, a few turns we're still dizzy from. And of course, yes, peeking ahead. So they are looking forward. Peeking ahead to the upcoming autumn budget, fiscal event, because apparently that sounds less scary. They'll be asking the question on all our minds, where is the money going to come from? And unfortunately for you, me, and just about everyone listening, the answer is probably us.
Well, that's a depressing thought. Thanks, Neil. But don't forget, The Tax Factor lands every Friday on the Blick Rothenberg website and all good podcast platforms. If you enjoyed today's episode or even just mildly tolerated it, please give us a like, maybe even subscribe so you don't miss next week's finale.
From all of us here, goodbye. Enjoy the summer while it lasts, because something tells me it's going to be a long autumn.
Goodbye.
That's The Tax Factor. If you enjoyed The Tax Factor, please like, share and subscribe. Join us again next time on the UK's top tax podcast, The Tax Factor. The Tax Factor is a Blick Rothenberg production. Copyright 2025.